The retirement risk zone. Welcome back. Consider this. You're in your 60s and excited to finally retire. You saved diligently but built up over $2 million in your portfolio, and you're ready to enjoy the freedom you've worked so hard for. But in your very first year of retirement, the market drops 20%. Suddenly, instead of drawing from a $2 million portfolio, you're only drawing income from $1.6 million. That one downturn, right at the wrong time, could permanently alter the trajectory of your retirement. And it's not just the market. Between ages 55 and 70, you'll make critical decisions about Social Security, Medicare, taxes, and withdrawals. Get those decisions right, and you set yourself up for decades of confidence. Get them wrong, and it's very hard to recover. That's why the period between ages 55 and 70 is often called the retirement risk zone, because the stakes are higher than ever and the margin for error is small. Hi, I'm Hank Persia, president and owner of Starboard Wealth Advisors. For years, I've helped high net worth retirees and pre-retirees navigate this exact window, ages 55 to 70, where planning decisions matter most. And I can tell you, this is where wealth can either be preserved and protected or quietly eroded. So in today's video, I'll walk you through why this age range is so financially sensitive, the biggest risks most people overlook, and practical steps you can take to safeguard your plan. If you find this helpful, make sure to watch our other videos for more retirement planning insights. And if you'd like to see how this applies to your personal situation, use the link in the description below to book a call with me. Let's get started. Part 1. What is the retirement risk zone? The retirement risk zone is the critical period that starts about 5 to 10 years before you retire and then extends for the next 10 years after you retire. For most people, that's ages 55 through 70 because your portfolio is at its peak. By your late 50s or early 60s, your retirement savings are often at their largest. That's good news, but it also means you have more to lose. A 20% market decline at this stage could erase hundreds of thousands of dollars, and unlike when you were 40, you don't have decades of new contributions to rebuild. You're also transitioning from saving to spending. During your working years, you were adding money to your accounts. If the market dropped, you kept contributing and waited for the recovery. But once you retire, you flip the script. Now you're withdrawing instead of contributing. A downturn during this stage, combined with withdrawals, can magnify losses and permanently reduce your future income. And you're making one-time irreversible decisions. This window is also when you'll make several financial choices that may be difficult or impossible to change later, such as when to claim Social Security benefits, how to claim any company pension benefit, whether to do Roth conversions while tax rates are favorable, how to position your portfolio for both growth and income, and how to prepare for Medicare and healthcare costs. The wrong decisions here can increase taxes, reduce lifetime benefits, or leave you exposed to risks that are harder to fix later. Simply put, the margin for error here is small. Think of the stage like the final approach to landing an airplane. You've spent decades in flight building your savings, but as you approach your retirement landing, the runway gets shorter. Oftentimes, mistakes at this point cannot be smoothed out over time. They simply need to be avoided altogether. That's why ages 55 to 70 are often called the retirement risk zone. It's not just another stage of life. It's the period where proactive planning can make the biggest difference in securing your financial independence. Part 2. The 5 biggest risks in the retirement risk zone. The retirement risk zone is so important because it combines 2 things. Your portfolio is at its largest and your margin for error is at its smallest. Let's walk through the 5 biggest risks retirees face during this stage. First, market downturns. As mentioned, a market drop right as you begin retirement can do far more damage than the same drop later on. This is called sequence of returns risk. If you're withdrawing income during a downturn, you're selling assets and investments at lower prices, which locks in the losses. That means your portfolio has fewer assets to grow when the market eventually recovers. This risk is especially high between ages 60 and 70 when people transition from paychecks to portfolio withdrawals. Second, poor withdrawal planning. Taking money from the wrong accounts or withdrawing too much money too quickly can accelerate how fast your portfolio depletes. Without a plan, you might trigger unnecessary taxes and also increase Medicare premiums without realizing it. The order and source of withdrawals matter just as much as how much you take. Third, Social Security timing. For many, Social Security represents a foundation of income. Claiming early at 62 may permanently reduce your benefit, while waiting until full retirement age or even age 70 can increase your lifetime income. But the right decision depends on your health, family history, and other income sources. A blanket rule does not work at this decision, as it truly needs to be tailored to you and your family. Fourth, healthcare and long-term care costs. From age 65 onward, Medicare becomes your primary health insurance, but it doesn't cover everything. Premiums, co-pays, out-of-pocket expenses can add up. Plus, dental, vision, hearing, and long-term care are often not covered at all. If one spouse requires years of long-term care, the cost can easily exceed $300,000, creating a financial strain for even high net worth families. And fifth, tax traps. This is one of the most overlooked risks. Between ages 55 and 70, you often have maximum flexibility with taxes. Before required minimum distribution RMDs begin at age 73, you can manage IRA withdrawals, do Roth conversions, or realize capital gains strategically. If you wait too long, those required withdrawals may push you into higher tax brackets, increasing your lifetime tax bill. Bottom line, each of these risks alone can cause problems. Together, they make the retirement risk zone the most financially sensitive stage of your life. Part 3, why this window matters more than any other. The reason the retirement risk zone is so critical is because you have both the highest stakes and the least time to recover. If markets drop when you're 40, you can wait it out. Keep saving and buying shares less expensively. But if they drop when you're 62 and you just started withdrawing income, the impact is far more severe. The same is true for taxes. If you delay planning until RMDs kick in at age 73, you may find yourself paying much more in taxes than necessary. If you act strategically between ages 55 and 70, you can often smooth out the taxable income, reduce lifetime taxes, and give yourself more flexibility later on. This is the window where proactive planning pays off the most. Part 4, 6 strategies to navigate the retirement risk zone. First, stress test your portfolio. Have someone model what happens if the markets fall 20% in your first year of retirement. Could you still maintain your lifestyle? Second, build a cash or income buffer. Having 1 to 3 years of expenses in safe assets may help you avoid selling stocks in a market downturn. Third, optimize withdrawal order. Coordinate withdrawals between taxable accounts, IRAs, and Roth accounts to balance income needs and minimize taxes. Fourth, consider Roth conversions. The years between retirement and RMDs may be an ideal time to convert some IRA assets into a Roth, locking in tax-free growth. Fifth, delay Social Security if it makes sense. For many retirees, waiting until full retirement age or even age 70 can significantly increase lifetime benefits, but this needs to be evaluated based on your health and income plan. And sixth, plan for healthcare long-term care costs. Explore supplemental coverage, long-term care strategies, or dedicated savings so you're not caught unprepared by rising medical expenses. Bottom line is this: the retirement risk zone between ages 55 and 70 is the most critical financial window you will ever face. Get this period right, and you may set yourself up for decades of confidence. Get it wrong, and it can be very difficult to recover. That's why thoughtful, personalized planning in this window makes such a big difference. If you're approaching this stage of life and want to make sure your retirement plan is built to withstand market swings, taxes, and healthcare surprises, let's talk. Use the link in the description below to book a complimentary consultation, and I'll help walk you through your options. Remember, at Starboard Wealth Advisors, your financial destination is why we're here. Thanks for watching, and if you found this helpful, make sure to watch our other videos for more clear, no fluff retirement guidance, or contact us for a simple phone or Zoom call. See you on our next video.